Hello, everybody. Welcome to another episode of Elevate and Renovate. My name is Michael Kern, your design build consultant here at LBK Design Build. Today, we're tackling one of the most important and asked about topics, financing. So whether you're looking to secure funding for a kitchen, addition, or just looking for tips in how to approach funding your next project, we'll be diving into the details of that today. Joined here today by Tom Yoswa, he's Senior Loan Officer and Renovation Specialist over at Renofi, who's here to break down some options, some myths, and just commonly asked questions. Tom, thank you for joining us.
Thanks, Michael. I appreciate it.
So you're out
in Denver right now.
I'm in Colorado. I do Renofi does business all over the country, and I have license in about 8 to 10 different states. Do a lot of business in New Jersey, Pennsylvania, East Coast, Illinois, Colorado. So I do business everywhere, but yeah, I actually live in Colorado.
Very cool. And what's kind of the details of being a renovation specialist? What does that entail?
So the short version is in 2003, I got into the mortgage business. So I was 40 years old at the time. And so I've been doing this for 22 years, almost to the day. And I primarily started at Wells Fargo back in the day, just working traditional mortgage stuff, but I quickly started specializing in renovation lending, which is basically back in the day was working with a lot of folks that were purchasing and renovating a property, a lot of first-time home buyers. We don't have a lot of those today, unfortunately.
Yeah, market stuff.
People renovate their house, by refinancing back in the day, whereas we would just refinance their loan and include the renovation money in it. But I've been at Renofi now for about 3 years, and this company is super unique because we have products that I've never had in my career before. That's the reason why I came to the company, and that's primarily what we'll talk about today. But I do have 22 years in working with contractors and clients, primarily in the mortgage space.
No, definitely. I mean, you've been helping out a lot of our clients, recently, secure funding. So you guys do a great job, and you make it a very easy, streamlined process to get through everything because it can be intimidating. Obviously, a first-time home buyer, like you were mentioning, starting this process of renovating their first home. So I guess it kind of leads me to my first question is, as a new homeowner who's new to financing a project, what are the main differences between Renofi and your loan options versus your typical traditional HELOC or personal loans?
So I would say the main thing, and when I talk to a customer for the first time, I'm fact finding. I want to know how long they've been in the house, how much they owe on the house, what is the house currently worth, and I'll get into numbers a little bit later. But those are important questions to me because the one thing I know about people, and this is 90% of the people I talk to, is that if they've been in their house for 3 or more years, which is the majority of the people that I talk to, and probably yourself also, they very likely have a low mortgage, right? I mean, I've got a mortgage in the 2s. I mean, if nobody's ever going to refinance my mortgage. So I know there's a lot of folks out there that have a $500,000-$600,000 on a primary mortgage at 3%, and they don't want to get rid of that loan. So basically, the way that it works with Renofi is we're not a traditional HELOC product. So you can go to your bank or credit union and get a line of credit based on the current value of your property.
Okay.
So let's just say for grins, because of this, my examples will kind of tell people kind of how this works. Let's just say you're talking to somebody and they owe 600 grand on their house that's worth 900,000. And let's say they want to do a $300,000 project, which includes maybe an interior remodel. Maybe they're going to add 700-800 square feet for a master addition or whatnot. 300,000 total. If you went to your bank or credit union and wanted to do a traditional HELOC, they will typically only loan you maybe 80-85% of the current value of the property. Okay.
Yeah.
What Renofi does is completely different. Is we still have that same HELOC product. However, we do them specifically for construction, and we loan on the future value of the property. Right. So the way that we get to that number is we do have an appraisal process. So once we get the plans and specs and the bids and all that stuff, kind of on the front end, we get two different numbers with the appraisal. We get the current value per the appraisal report with comps, and we get the future value, which is basically the after improved value. With Renofi, we can loan 125%. Actually, in back east New Jersey, Pennsylvania, we can loan up to 150% of the as-is value of the property minus what they owe on their mortgage, or 90% of the post-renovated value minus their mortgage, the lesser of the two. So if you did the math on that, if they were able to get maybe $150,000 with a traditional line, we might be able to get them $400,000 or $500,000 with the Renofi product.
So that would leave them the opportunity, based on the scope of their project, to explore other parts, as far as maybe they include, another bathroom, or they really focus on their dream space, right? Being able to secure additional funding like that.
1,000%, because when folks go into a project, it's overwhelming in the beginning. I talk to thousands of people that are doing renovations on their property. I get it. It's overwhelming. You've never done it before, trying to figure out how you're going to pay for it, et cetera. But yeah, I mean, it gives them the peace of mind in the beginning to know that if their project is, let's just use my example, 300,000, then can I get that? Yeah, I'll be able to get that money for them, right? I still have to get them qualified and everything. It's still a loan. It's a secondary loan on the property. But also you're exactly right. I mean, when it happens a lot too, when I'm going through the numbers, they're like, initially we thought we'd only be able to afford this based on, what we thought about our house. But once I give them that little carrot, if they can loan on future value or borrow on future value, that opens up everything else. So then it just comes down to the max of what I could loan them based on the appraisal I get back, and then what their appetite is for what they want to do to the property at that point.
Absolutely. It seems like it's a no-brainer to go that route versus like a personal loan when it comes to these types of projects.
No, of course, yeah. Personal loans, typically we have one outlet for personal. We have 3 outlets for personal loans, but only one that we can go up to 100,000. I think with a personal loan, yeah, maybe they're quick close and everything, but they're not a lien on the property, so they're not secured to the property.
Okay.
Anytime you're dealing with a loan that's not secured to the property, the interest rate's higher.
Mm-hmm.
So, I've done plenty of personal loans for people, but those rates might be 12, 13%.
Wow.
Whereas with our HELOC product, you're going to get a similar interest rate than you could get with a traditional HELOC. It's in a lot of ways, it's funny because I've been at Renofi for 3 years. In a lot of ways, the loan's almost too good to be true to the homeowner, because we're loaning on future value, to the contractor because we don't do draws or inspections or anything like that. And also for the homeowner, first and foremost, it is not a refinance. We are not touching your 3% mortgage.
That's good to know, because I think it's a common misconception that a lot of homeowners, fear. If I have to go look for a loan for this renovation, I'm going to lose my interest rate.
Yeah, it happens all the time, because in my previous world, the only way I could finance a big project like that on future value was to either do a construction loan or to do a renovation loan. A renovation loan is just like a Fannie Mae conventional, where we only loan it's a future value product, but it also refinances. The construction loan and a renovation loan will refinance you out of your first mortgage. So, there's nobody out there that wants to go from 3% to 6.5% or 7%.
No, absolutely not.
We already know that. So the interest rates on the seconds that we have, the interest rates on the seconds we have aren't 3% either.
Mm-hmm.
But we don't touch that first mortgage.
But it sounds very appealing for the homeowner. But you mentioned not doing draws and inspections. That's very appealing for the contractor and the business, correct?
Oh, 1,000%.
Making sure they get their money on time and get paid on time.
1,000%. Because the other way is we escrow the money. There's draws and inspections. There's what they call escrow holdbacks, where you might need 40 grand to pay for something, and they'll give you 3,200 of it, because there's what they call a holdback to make sure there's no liens at the end or anything. In this scenario, it works just like a regular line of credit. If anybody out there listening has ever done just a HELOC on their property, it works the same as a HELOC. You're going to get a checkbook. You're going to get a debit card. Just the difference is that we're loaning you more money because we're loaning on that future value.
Got it. Understood. Yeah, because we commonly see when we're going through the design process, either a project possibly stalling or need to scale back due to financing. So at what point in the process would you recommend a client reach out to you or start this conversation about exploring potential loan options?
I always say as soon as possible. No matter if a client finds us organically or they're a referral from you guys, the earlier we can talk, the better, because there's other things that might be deal killers too. We don't want to get too far in the process if if there's credit issues with the client, or if they just bought the house. Like, I'll get this. I had one recently where highly qualified guy, 800 credit, just bought his house a year ago, but he bought it with a VA loan.
Okay.
Well, with a VA loan, they're great, but you also put zero down. So you technically have zero equity in your property. So if we're talking about the scenarios, if I can loan 125% of the as is or 90% of the after improved, even if we got a good after improved value, they don't have any equity to begin with. So those are the numbers that I like to look at is, do they have a little bit of equity? Do they have a lot of equity? With what we're talking about doing to their properties, is it going to work? Or is a portion of it going to work? And it's better to know that 20% of the way into what we're doing before we get plans and specs and all that stuff, rather than 80% of the way down the road. But yes, I'd say the earlier the better. It's just like, think of it as getting pre-qualified. You're going out to look at houses, and you want to know that you're pre-qualified for what you're going to buy.
Yeah, you need to know what you're shopping for.
Pre-qualified more or less for renovation financing.
So what are some of the other key factors when you're talking to a client about getting pre-qualified? What are some of the other factors that you would need from a client to make sure that they're prepared when having that first conversation with you guys?
Basic stuff, because again, keep in mind, this is just a loan, right? It's a secondary lien on the property. You have your primary mortgage, this is a secondary loan on it. So first and foremost is to make sure I can get them approved based on the numbers that we're looking at for the reno, but also that I can get them approved, on the just the loan part of it. Because we're collecting just like any other loan that they've done in the past: W-2s, pay stubs, bank statements, IDs, mortgage statements, all that stuff. So I need to look at the complete picture for everybody. 90% of the people I talk to have decent credit, W-2 jobs, everything checks out just fine, right? But there are times when somebody's self-employed and they've only been self-employed for a year. Stuff like that won't work because we underwrite to the same guidelines as regular mortgages. But it's not to say I can't deal with self-employed people. I do it all the time. It's just that if you started your business 6 months ago, then it's highly likely that we're not going to be able to do anything for you at this point.
Gotcha. Understood. Now, as far as
customer qualified,
as far as timeline goes, when a prospect or a client starts this process, what's kind of the life cycle for how long it takes?
So again, in the beginning is just the pre-qual stage. We have within the program with Renofi, after I've talked to somebody and everybody's like, yeah, it's a great product, Tom, let's move forward, then I will do what we call convert their loan. And at that point is when they send me all their loan documentations. We have a task list that we give them. Probably 8 or 9 of the 12 tasks that are on this list are for the customer. All the stuff we talked about, mortgage statements, all that stuff. Yeah. The rest of the stuff is from the contractor. So from the contractor, we're going to need like an itemized estimate, the plans and specs. We need to know what you're doing and how much it's going to cost. The construction contract, just stuff that you do every day, Michael, with your business, with your clients. We need that stuff.
Yep.
That stuff is super important because about the middle part of our process, like getting them qualified is easy. I can get them processed, underwritten, all that stuff. That's easy. But we can't even order the appraisal until we get plans and specs and the itemized estimate, because we have to have something to give to the appraiser when they go out to the property. So really it comes down to answering that question is, I can kind of move as quickly as you want me to, right? If somebody's, planning something, they don't quite have all the plans yet, and you're working through the budget and we don't have everything for 6 weeks, it might take us 9 weeks to close the loan, right? The other part of the process is, so it's qualifying them in the beginning, the construction phase where we get all those documents. The last part is with Renofi, we are a broker to over 20 credit union partners across the country. So these credit unions don't have the Renofi product themselves. They use Renofi as their partner to do everything, which includes all the financial stuff, all the contractor stuff, all the appraisal stuff. After we get all of that, we ship it to our credit union partner, and then they actually approve the loan. and they fund the loan. So your borrower is actually working with like US Alliance or Quorum, like one of the big credit union partners we have. And that's who the loan's actually with, not with Renofi. So
Makes sense.
again, if we went 3 weeks in the beginning to get everything polished up with the borrower, 2 weeks to get all the construction stuff together, get the appraisal order, we get the appraisal back. Technically, you're on average 3 to 4 more weeks with the credit union. That's about an 8-week period. So I would say on average about 60 days from the first touch to the day we close, if it's a real doable deal.
Well, sounds like you need to have pretty good communication amongst all three parties to make it a seamless transition for the client.
Always. And we've got processors that work with us just like a regular loan company. So we need something, the customer is going to know that we need it. If we need something from you, we have a due diligence team and a construction department. They're going to ask you for what they need. And I'm kind of the one that pulls everything together.
Oh yeah, I get the email notifications as soon as I see it pop up. I'm in there dropping documents. So it's very, very easy on the construction side of things as far as documents.
But other times you're not ready. You don't have quite all the stuff you need. You don't have your bids from your trades yet, or there's a change order or something like that. But once we actually get through the process and we close the loan, so now everything is great. The borrower has told the credit union that we need, $40,000 worth of startup money. We'll release that at the close, right, into the bank account that we have set up with them. They'll set up an account with the credit union. From that point forward, it's just a line of credit. So, it's for construction. It's not, free for all money. It's for construction. And we do check in during the process. We check in once a month on the project, and there's some costs, there's closing costs and all that stuff with the loan. May as well get into that real quick if that's okay.
Yeah, absolutely.
Yeah, absolutely.
Closing costs are typically 1% of the loan of the line of credit we got you approved for. So let's say it's a $300,000 line of credit from the earlier example I used. So that's $3,000. They're going to charge $700 for processing and underwriting, they being the credit union, right? By law, if our loan is over $250,000, we have to have a title update. We have no control over that. Title could be anywhere from $1,200 to $3,000. We don't know. Depends on the city, the state, the county. It just depends on a lot of different things. And then one time per month, we do a construction check-in, and that's $150 a month. But all of that is taken out of the line of credit. So theoretically, if your customer wanted nothing out of pocket, then it's coming out of the line of credit at the beginning.
Got it. Understood. Is there a certain type of project that you sees the biggest benefit from a loan?
Bigger ones.
Bigger ones with a lot of the unknowns.
Not that I haven't done $60,000 kitchen remodels. I have. But I'd say the majority of the people that you're talking to that are doing $60,000 kitchen remodels either have the cash or they've got a little line of credit set up through their local bank or credit union. So they don't need me, right? I'd say my average size deal with the majority of my big design build contractors across the country is probably anywhere from $250,000 to $750,000. I could take my loan amount up to $750,000. So, but that sweet spot is probably in that $250,000 to $350,000 range is what I would say.
That makes sense. Do clients ever talk to you about like incorporating some kind of contingency budget into their loan?
I always recommend it. We can add 10% through all of our credit union partners. And so whenever, somebody comes to me with that $300,000 project and we have the wiggle room to do it, remember the appraisal is going to tell us what we need. There are times I'm trying to get $300,000. Appraisal comes back and I can only get them $250,000 because I can only do that either or 125 of the as is or 90 of the after improved. So the appraisal will tell us everything we need to know. But if they have the wiggle room, I always recommend a contingency because there's change orders, there's cost overruns. There's anything can happen with a large.
Yeah, especially with the big ones when you're talking about additions, when you got to get engineering involved and the township and stormwater management. Those are all things that you kind of need to iron out those details. And you may not necessarily know very early on in the process. So it's good to have that in the back of each person's mind for sure.
1,000%. And along the lines of the average loan amount, a very large percentage, let's say at least over 50% of my deals include square footage.
Mm-hmm.
We're putting on a second story. We're finishing off an attic that has the little steeple or the dormer, whatever they call it, at the top. And we're working around that and adding a 600 square foot master suite and a new bathroom. We're putting an 800 square foot addition onto the property, into the back of the property.
Mm-hmm.
We're adding an ADU. ADUs are becoming huge.
Yeah.
So we could finance ADUs all day long, right? Again, zoning on future value. But sometimes with ADUs, the biggest issue that you have is the appraisal. Because, with appraisals, you have to appraise to a like property. Back east, it might be a little easier than in Colorado. Like the month of July, I closed 2 big ADU deals. Both of them were over 400,000.
Wow.
And they both worked out great. We found comps, and so we were good. So, but ADUs, additions, pop tops, complete home remodels. Like just another example, I had one yesterday. A guy in Illinois purchased a house, put down 20%. When I'm talking to the guy on the phone, I was looking at the house with him. He purchased the house because it was in a great area, right? The house was not what they want to live in. Okay. So before they're even moving into the house, and they put down 20%, they have like a $300,000 renovation that they've already talked to contractors about that they want to do. This house they've never even moved into yet, right? The fact that they put down 20% when they closed will give me enough wiggle room that I can loan them that $300,000 on a house they've never even set foot in. So they bought it, they either paid cash or financed it in the beginning, and then I come in with my loan on the back end doing a second based on future value. So it works. It's going to work out perfectly for these folks.
Yeah, no, we're seeing a lot more of that. It's very common now that people are finding homes and realizing it needs work to be done. And before they want to move in, they want to explore the options of remodeling the entire first floor or the second floor. So it's good to know that that's an option that they can go against future value.
Yep, 1,000%. Whether they've been in the house for 20 years or 2 months, if the numbers work, the numbers work.
It's all about the numbers, isn't it? That's what it always comes down to.
It's just the business we're in, right?
So what are some of the common misconceptions, Tom, or fears that clients may have about a renovation loan that you've had to overcome or they've shared with you?
Gosh, like maybe rates. I mean, the rates must be really high. I mean, not necessarily. In my world, rates start at prime. Okay. So if over the last couple of months, the prime rate has dropped twice a quarter. So right now, prime is at 7%. We're hoping that keeps trickling down. During the pandemic, or right after the pandemic, 2022, they skyrocketed to like 9% or whatever the number went to. So it's a variable rate loan. So as the prime rate drops, the customer's rate will drop. So I would say rate is one. Number two is always, is thinking that they have to refinance their house. And that is not the case. So keeping your primary mortgage, variable rate on the second. Just trying to think like objections, like it's interesting because when people talk to me, even contractors talk to me, they don't have any idea that this product exists anywhere because they've never heard of it before. Or they might have found it on a Google search or because we're all over, SEO stuff, search engine, et cetera. But once they figure out what the product is and what they can do with it, it just opens up a whole new world to people.
Oh yeah, no, it certainly makes everything easier for both the client and the company, for sure.
Yeah, 100%.
So I guess the last question I got for you, Tom, would be for someone who's listening in today, what are the first 3 steps that they should take when it comes to starting their financing journey for a project?
Well, that's a good one. So I'd say number one, just identifying exactly identify your perfect world scenario and what you want to do to your house. Because again, maybe we talked about this earlier. Maybe if you think that you can only, do the interior of the property and renovate it, and you won't have money to do that 400 or 500 square foot addition you want to put on the back, maybe that opens up that possibility for you. So try to figure out exactly what your plan A wish list is for the property. B is, and we talked about this, I don't know if we mentioned it earlier, but separately from our talk here, I get a ton of people who have cash, right? They're like, we have cash to put into our deal, right? So two things are going to happen. Either one, the renovations end up being more than what people think they're going to be, because that always happens, right?
Mhm.
They've talked to their friend that did it 3 years ago and it cost this, and that's just not the world we live in now. We all get that, right? So I deal with a lot of people who, yeah, they have cash, but either A, they don't want to use it all, right? Or they don't want to use any of it. So I mean, but I have to do with people that are doing a $500,000 reno and they're putting 250 into it, and I'll just do a $250,000 supplemental loan to their cash.
It's always better to spend someone else's money than your own, right?
Well, yeah, I mean, if you're savvy and you're making 10% on your money, or whatever, then and plus you're paying a penalty a lot of times. If you're taking money out of an IRA, I'm over 59 and a half now. It's a little easier, but I'm still paying 20% on everything I take out of a Schwab account or Fidelity account. So unless you have actual cash, you're probably paying money to get your cash. And it's almost a guarantee that your financial advisor would say, let's keep your cash invested, and borrow money at 7% or whatever. It's just, I guess, the math of it all, if it works. But some people are like, this is my project, I'm paying cash, and they'll never talk to me, right? Other people are like, I want to finance the entire thing. I want to keep my cash, and that they will talk to me. And then we got the one right in the middle that's like, renovations ended up being more than what we thought. I'm putting cash into it because that's what I've earmarked this $200,000 of cash for. But if I could borrow another 300 on top of that, I'd surely be interested in doing that. And they get to me that way as well.
Very cool. Well, that concludes today's episode, Tom. I really appreciate you carving out some time and sharing your knowledge with us. Any final thoughts you'd like to share with the audience?
Any other questions?
Any final thoughts you'd like to share with everybody?
No, I think it's just, as you guys are talking to LBK and you're early on in the process and you're kicking the tires, I just recommend, whether you end up using me or not, you should know what my project offers you. And if it works, great. If it doesn't, then at least, you kind of know what a good solid option would be. But it's renovating is happening everywhere because people aren't moving for the most part. I mean, somebody's got a 2.5% interest rate. They're going to think 3 times over before moving into that bigger house at 7%.
Absolutely.
Where they have a nice lot and they like the schools and they found a way to add 800 square feet to their house and not have to touch their first mortgage. I mean, that's the beauty of what we do.
No, I make sure I include your pamphlet in every folder I give out. Cool. Well, that concludes today's episode, guys. Thank you for joining us. My name is Michael Kern with LBK Design Build. New year, new space. Time to refresh your kitchen and bath this spring. Join LBK Design Build February 7th, Saturday from 11:30 to 1:30 for our Brunch and Learn seminar right here in our design center. Come enjoy a free brunch and get expert insight from our president on budgeting, timeline, and what to expect during your remodel. Spots are limited, so make sure you reserve your spot today through the link in our bio. LBK Design Build. Designed for a living, built for life.